Bitcoin isn't crashing because of bombs. It's not crashing because of missiles. It's not crashing because of headlines. It's not even crashing because of fear. It's crashing because of something most retail traders never talk about, never study, and honestly, never even consider when they're staring at red candles at 2 a.m, wondering what just happened to their portfolio. It's crashing because of liquidity. And if you don't understand what that word actually means, not the textbook definition, but the real structural institutional definition of that word, you are going to trade the next move in this market completely, catastrophically wrong. Stay with me. Because what I'm about to break down for you in the next 18 minutes is the kind of macro framework that hedge fund analysts use. It is the lens through which smart money actually reads the market. And once you see it, you cannot unsee it. Welcome to the wealth continuum. Let's get into it. All right, let's start with what everybody already knows. Because before we can dismantle the narrative, we have to actually understand the narrative. Here's what the headlines are saying right now. Tensions in the Middle East are escalating, and not in the slow, simmering way we've seen over the past few decades. We're talking about direct military coordination. We're talking about Iran's expanding regional influence, proxy conflicts heating up across multiple theaters, and now the United States and Israel deepening their operational alignment in ways that haven't been seen in years. Every major financial news outlet is running the same story with the same framing. Geopolitical risk is spiking and markets are reacting. And they're right. Markets are reacting. Bitcoin dropped. Ethereum dropped. The entire crypto market at various points looked like someone hit a big red button. And if you were watching your portfolio, you felt it. Now here's the instinct that almost every retail trader has in that moment. They open Twitter, they open Reddit, they open YouTube, and they start looking for the geopolitical explanation. Oh, it's the war. Bitcoin is dropping because of the war. And that explanation feels satisfying. It's simple. It's emotional. It connects a scary headline to a scary chart. And it gives you a reason to either panic sell or sit on the sidelines and wait for the bombs to stop falling before you make your next move. But here's the question I want you to sit with right now. And this is the first question that separates retail thinking from institutional thinking. If war causes Bitcoin to crash, why did Bitcoin rally during other geopolitical crises? Think about that. When Russia invaded Ukraine in February 2022, Bitcoin initially spiked. Ukrainians were using it to move money across borders. Russians were using it to escape capital controls. For a brief window, Bitcoin actually behaved like a safe haven. So why is it behaving differently now? This is not a rhetorical question. The answer to this question is worth tens of thousands of dollars to you as a trader or investor, because it tells you not just what happened, but why it happened, and more importantly, when it will happen again. And that answer has nothing to do with the Middle East. That answer lives in one word: liquidity. But before we get there, and I promise we're going to break this down in a way that actually makes sense, I need to ask you something. If you've never heard the wealth continuum break down macroeconomics and crypto markets together like this, consider subscribing. Because this is what we do, not hype. Not price predictions, real frameworks, real thinking. Hit that button if you want more of this. And now let's get into the real reason your portfolio is bleeding. Okay, let's talk about liquidity. Most people hear that word and they think it just means cash, and that's partially true. But in macro terms, liquidity is something much bigger. Liquidity is the availability of money to move through financial systems. It's the fuel that powers every asset class: stocks, bonds, real estate, and yes, crypto. When liquidity is abundant, money is cheap, credit is easy, and investors are willing to take risks. They buy tech stocks, they buy meme coins, they buy early stage startups. Risk appetite goes up because there's so much fuel in the system that people feel comfortable putting money into speculative assets. When liquidity tightens, when that fuel supply starts to shrink, the opposite happens. Investors pull back from risk. They move toward safety. And anything that is speculative, volatile, or doesn't pay a yield gets sold first and sold fast. Now here's where the Middle East comes in, not as the cause of the crash, but as the trigger that initiated a liquidity shock. Here's the chain reaction. Walk through this with me carefully, because every single link in this chain matters. Step 1, war causes an oil spike. Any significant escalation in the Middle East sends oil prices up. This is not a political statement. It's a geographic reality. The Strait of Hormuz, through which roughly 20% of the world's oil supply travels, sits in the Persian Gulf. Any military tension in that region creates supply uncertainty. And when oil supply looks uncertain, oil prices go up. This is basic commodity logic. Step 2, oil spike reignites inflation fears. When oil goes up, everything goes up. Transportation costs, manufacturing costs, food costs, energy costs. These aren't isolated price increases, they ripple through the entire economy. And when inflation starts creeping back up, or even looks like it might creep back up, People responsible for fighting inflation have to respond. Step 3. Inflation fears mean central banks stay hawkish. And who fights inflation? Central banks, the Federal Reserve, the ECB, the Bank of England. These institutions control interest rates. And interest rates are, at their core, the price of money. When rates go up, borrowing becomes more expensive. When borrowing becomes more expensive, less money flows into the system. And when less money flows into the system, Step 4, liquidity tightens. This is the critical moment. This is where the domino falls that takes everything else down with it. When central banks signal they're staying hawkish, meaning they're keeping rates high or even raising them further, the institutional world reacts immediately. Bonds become more attractive because yields are going up. The dollar strengthens because high rates attract capital to dollar-denominated assets. And suddenly, the cost-benefit analysis of holding a speculative, non-yielding, volatile asset like Bitcoin starts to look very different. Step 5, risk assets dump. And here we are. Bitcoin drops, Ethereum drops, altcoins get absolutely obliterated. Not because of the war, not because of the missiles, but because the war triggered an oil spike, which triggered inflation fears, which triggered hawkish central bank positioning, which triggered a tightening of the very liquidity that was keeping speculative assets elevated in the first place. Now, I want you to stop for 1 second, because I need to ask you something. Have you ever wondered why Bitcoin and the NASDAQ move together so often? Have you ever noticed that when tech stocks sell off, crypto sells off? Have you ever noticed that when the Fed does something dovish, when they cut rates or hint at cutting rates, crypto pumps almost immediately? That's not a coincidence. That is the liquidity mechanism in real time. Crypto doesn't move on headlines. It moves on liquidity. Say that again. Write it down if you have to. Crypto doesn't move on headlines. It moves on liquidity. The headline is just the story. The liquidity is the actual force. And here's why this matters so much right now. If you're sitting there waiting for the Middle East situation to calm down before you make your next move in crypto, you're watching the wrong variable. You need to be watching the bond market. You need to be watching dollar strength. You need to be watching what the Fed says at the next press conference. Because when liquidity starts coming back, and it always does eventually, how much Bitcoin will move, not because peace broke out, but because money started flowing back into risk assets. That's the framework. And we're not even halfway through. Stay with me. Now, I want to address something that frustrates a lot of long-term Bitcoin holders, and honestly, something that needs to be addressed directly because it affects how you think about Bitcoin as an asset. For years, since the early days, Bitcoin was marketed as digital gold. The pitch was simple and it was compelling. Bitcoin has a fixed supply of 21 million coins. Gold has a fixed supply on Earth. Both are scarce. Both are decentralized. Both exist outside the traditional financial system. And therefore, just like gold rallies when things get scary, when there's geopolitical uncertainty, currency crises, inflation, Bitcoin should do the same thing. That pitch made Bitcoin very attractive to a very specific type of investor, the macro hedge investor, the person who looked at the Federal Reserve printing trillions of dollars and said, I need something outside that system. But here's what actually happens during a major geopolitical shock. When things get genuinely scary, not market correction scary, but missiles are flying scary, money moves into what institutional investors call safe haven assets. And safe haven assets in 2024 are physical gold, the dollar, US Treasury bonds. Notice what is not on that list: Bitcoin, Ethereum, crypto. And this isn't a knock on crypto. This is just a structural reality about where we are in the maturation of this asset class. Bitcoin is still, in the eyes of the institutional world, a risk asset. It is in the same psychological bucket as high-growth tech stocks. It is speculative. It is volatile. And when real fear hits, or when fund managers need to de-risk their books immediately, they don't rotate into Bitcoin. They rotate out of it. Now here's where it gets interesting. And here's the question I want you to actually think about, not just here. When does Bitcoin actually behave like a hedge? Because the answer exists. We've seen it. I mentioned Ukraine earlier. We've seen it in countries experiencing hyperinflation. Venezuela, Argentina, Turkey. We've seen it when capital controls are imposed and people desperately need a way to move money across borders. Bitcoin behaves like a hedge when traditional financial infrastructure fails at the individual level, not when there's a geopolitical shock that the traditional financial system can absorb, not when the US dollar is strengthening and treasuries are functioning normally, but when the banking system itself breaks down, when people can't access their accounts, when governments freeze assets, when currency collapses so fast that holding anything in local fiat is financial suicide. In those moments, Bitcoin is digital gold. In those moments, the on-chain volume from affected regions spikes. The peer-to-peer premium goes through the roof, and Bitcoin does exactly what its early believers said it would do. But in a Middle East conflict where the US is involved and the dollar is strengthening, that's not that moment. That is the opposite of that moment. That is a moment where the traditional financial system is functioning, the dollar is seen as safe, and risk assets like crypto get sold. This is not a contradiction in Bitcoin's thesis. This is a nuance in Bitcoin's thesis that most retail investors never take the time to understand. And understanding it protects you from making the wrong move at the wrong time. Are you starting to see how much context matters? Because context is everything. And we're about to go even deeper. Okay, so far we've talked about what's happening on the surface. We've talked about liquidity. We've talked about why Bitcoin isn't gold yet. But now I want to go somewhere that I think is genuinely underreported, genuinely important, and genuinely bullish for crypto over the long term, even if it's terrifying in the short term. I want to talk about the structural shift happening in global finance right now as a direct result of geopolitical tension. Here's the thing about sanctions. When the United States or the West imposes financial sanctions on a country, when they cut a nation off from SWIFT, freeze central bank reserves, restrict access to the global dollar system, something interesting happens. Those countries start looking for alternatives. We saw this with Russia after 2022. We saw it with Iran. We're seeing it now with other nations that are watching what happened to Russia's $300 billion in frozen reserves and thinking, we need a plan B. And increasingly, that plan B involves crypto, not necessarily Bitcoin as a store of value, but crypto as cross-border financial infrastructure, stablecoins as a way to settle trade outside the dollar system, blockchain-based payment rails as an alternative to SWIFT, on-chain finance as a way to move capital when traditional channels are closed. Now think about what this means for crypto adoption. Every time the United States uses the dollar as a geopolitical weapon, and they use it more and more, they are inadvertently creating demand for alternatives. Every sanction is an advertisement for financial sovereignty. Every frozen account is a case study in why you might not want all your assets inside a system that can be weaponized against you. And this creates a fascinating paradox. In the short term, geopolitical conflict hurts crypto prices because it tightens liquidity. But in the medium to long term, geopolitical conflict accelerates the very adoption that Bitcoin and crypto were built for. The countries being sanctioned are running experiments right now in crypto-based trade settlement. Regional economies that are being cut off from Western financial infrastructure are building on-chain alternatives. Individuals in conflict zones are holding USDT because it gives them dollar exposure without requiring a US bank account. This is not a small thing. This is a fundamental rewiring of how global finance works. And crypto is right in the middle of it. So here's the question you need to be asking yourself as an investor. Are you looking at crypto as a short-term trade or as a long-term structural position in the most significant financial paradigm shift in 50 years? Because how you answer that question determines everything about how you should respond to short-term volatility. If you're a short-term trader, then yes, watch the liquidity signals, watch the Fed, watch the dollar. Time your entries and exits around macro cycles. But if you're a long-term holder, if you believe that the global financial system is fragmenting, that the dollar's dominance is slowly but surely being challenged, that the demand for censorship is resistant, borderless financial infrastructure is going to grow as geopolitical tension grows, then short-term volatility is not your enemy. It is your opportunity. And that's a perspective I don't think enough people in this space are talking about. But here at the Wealth Continuum, that's exactly what we're here to do. So if you're not subscribed yet and you're still watching, which, by the way, thank you, it means something, hit subscribe, because this is the kind of breakdown we do every single week. All right, let's get to the part that I know a lot of you have been waiting for. You're not just here for the education, you're here because you want to know what to do, what to watch, what metrics actually matter. So let me give you the 5 things that smart money, institutional investors, macro hedge funds, quantitative traders are actually watching right now. Not price, not Twitter, not the headlines from the Middle East. These 5 things. Number 1, dollar strength, the DXY index. The dollar index measures the strength of the US dollar against a basket of major currencies. And here's the relationship you need to understand. When the DXY goes up, risk assets tend to go down. When the DXY goes down, when the dollar weakens, money flows into alternatives, into gold, into equities, and into crypto. Right now, geopolitical tension is pushing capital into the dollar because the dollar is seen as a safe haven. Watch the DXY. When it starts rolling over, when you see it make a lower high and start declining, that is often a leading indicator that risk appetite is returning and crypto could move. Number 2, oil futures. I already explained the oil inflation Fed chain reaction. So here's how you actually apply it. Watch crude oil futures, specifically WTI and Brent. If tensions escalate and oil spikes above certain levels, inflation fears intensify and the Fed has less room to pivot dovish. If oil stabilizes or pulls back, the inflation narrative cools, the Fed gets more flexibility, and liquidity conditions can improve. Oil is not just an energy commodity. In today's macro environment, oil is a leading indicator for monetary policy direction. Watch it, like you watch the Bitcoin chart. Number 3, U.S. bond yields, specifically the 10-year. The 10-year Treasury yield is arguably the most important number in global finance right now. Here's why. When yields are high, the risk-free rate of return is attractive. Why would you hold Bitcoin, which is volatile, pays no yield, and could drop 50%, when you can get 5% risk-free from a government bond? You wouldn't, and institutions don't. They sell Bitcoin and buy bonds. But when yields start falling, when the bond market starts pricing in rate cuts, the calculus flips. Suddenly, the risk-free return isn't that attractive. Suddenly, the opportunity cost of holding Bitcoin comes down, and capital starts looking for higher returns again. Watch the 10-year yield. When it starts to decline meaningfully, that is a green light signal for risk assets. Number 4, stablecoin inflows and outflows. This one is specific to crypto, and it is one of the most powerful on-chain signals available to us. Stablecoins, USDT, USDC, are the cash equivalent of the crypto market. And when money is nervous, it moves from volatile crypto assets into stablecoins. When it's ready to risk again, stablecoin balances on exchanges start moving into crypto positions. Watch stablecoin inflows to exchanges. Watch total stablecoin market cap. When stablecoin capital is building up on exchanges, it means dry powder is accumulating. It means people are waiting to buy. And when that buying starts, prices move fast. Number 5, exchange reserves. This is another on-chain metric, and it tells a fascinating story. Exchange reserves measure how much Bitcoin is sitting on centralized exchanges. When reserves are high, it means Bitcoin is available to be sold, and selling pressure exists. When reserves are low, it means Bitcoin is being withdrawn to cold wallets, which typically signals a holding mentality. Long-term holders are taking their coins off exchanges because they don't intend to sell. Right now, look at exchange reserves. Are they rising, meaning people are depositing Bitcoin to potentially sell? Or are they falling, meaning people are holding? The answer tells you more about market psychology than any price chart. Here's the key takeaway from this entire segment. Smart money is not reading the news to trade crypto. Smart money is reading the macro data. The news is the lagging indicator. The macro data is the leading indicator. And the traders who understand this, the ones who are watching DXY, oil futures, bond yields, stablecoin flows, and exchange reserves, those are the traders who are positioned before the move happens, not after. That's the difference. And that's the game we're playing here. Let's zoom out for a second. We started with a real geopolitical conflict in the Middle East involving Iran, Israel, and the United States. But here's what actually matters. The war isn't the root cause of crypto volatility, it's the catalyst. The real driver was already in place. Tight global liquidity, a hawkish Federal Reserve, a strong dollar, and elevated bond yields. The conflict simply accelerated a liquidity squeeze that was already happening, and that what you were feeling in your portfolio. At the same time, those same geopolitical pressures are strengthening the long-term crypto thesis. Sanctions increase demand for censorship-resistant money. Capital controls increase demand for borderless payments. Financial fragmentation increases demand for decentralized infrastructure. Short-term volatility is real, but so is the long-term structure. The investors who win the next cycle won't be the ones reacting to headlines. They all be the ones tracking liquidity. The next major move isn't coming from the battlefield. It's coming from the bond market. When yields roll over and the Fed pivots, institutional capital will rotate back into risk. And when that happens, the move will be fast. If this framework changed how you see the market, share this with someone blaming the wrong narrative, and subscribe to the Wealth Continuum for macro signals that actually move markets. I'll see you in the next one.